a bad idea. But he was pretty good paid too. And my buddy like 21 started.
And then she had to take it. You really have to walk in and like know from the start. It's pretty.
I mean, like I know it's like 2 years.
I might as well get it
It's still
maxed.
pretty good.
That's
For
what I
like
was
out too. No, I
Hello, everyone. Warming up out there for big plans for today. I hope we get through the remainder of chapter 6. A lot of slides, but I think there's not a lot of content with the slides, so I think we can get through it. But we're going to try to get through steps 4 and 5, financial statement, footnote disclosure. So 4 is all about the valuation allowance exercise that we need to do. Step 5 is financial statement disclosure, or sorry, uncertain tax positions that we have to assess, and then financial statement disclosure. But might go a little quicker. So step 4 is determining whether we need a valuation allowance on DTAs. And always remember, we don't do a valuation allowance assessment on DTLs, okay, for tax liability. Why is that? This is the general accounting bias against assets and liabilities. We test assets for realizability, and we don't carry them greater than their fair market value on the balance sheet. We don't have the same concern about liabilities for accounting, right? We always accrue liability. Natural conservatism of accounting. So we have a valuation allowance, which is testing for tax assets for that reliability. And so we need to evaluate each of our gross DTAs. So we did DTAs on Monday. So every one of those in those examples, we need to go in and test, are they realizable or not? That process is called the valuation allowance process, or VAs. Everybody calls, do I need a VA on that DTA? So, the income tax benefits associated with DTAs can be realized, and that means it's always convertible into cash, only if the company expects to have sufficient taxable income in the future to absorb the future tax deductions or credits that give rise to DTAs before they expire. So, we're going to be dealing with things with book tax differences that give rise to future deductions. Future deductions are only worth something to you if I have future income, right? So that's what we're going to be testing against. In the future, do we have sufficient income to utilize those deductions? That's before we can before we can keep the gross DTA on the books. Okay. Now, we'll see. We do have some attributes that have carried back potential and carry forward. The most common one is capital loss carry forwards, right? We can't deduct the capital loss except against capital gains. We don't have that in the current year. We go back 3, go forward 5. I always think about going backwards is easy, right? I just look at the tax returns. I just go pull them out of the file. Did I have capital gains in the prior 3 years? That's a yes or no question. The future is unknown, right? So that's where I'm going to focus on the VA analysis, is proving that unknown. I think proving the carry back potential is just looking at the files. Do I have potential or not? And does the tax item I'm looking at provide for a carry back? Many items only provide for a carry forward. Okay, the standard is more likely than not, meaning that if a company determines that it is more likely than not, greater than 50%, not exactly 50, but greater than 50, that some portion or all of a DTA will not be realized in a future year due to the lack of potential taxable income, it must record a valuation allowance against that gross DTA to reflect the amount the company does not expect to realize in the future. Okay, I can't carry the asset just like any other asset on the balance sheet greater than what I can realize it for, i.e. converted into cash. So if that DTA, even though it's a future tax deduction, I'm not going to be able to get it, that's the VA process. I'm going to reduce the gross DTA down to what is real. So So valuation allowances are contra asset accounts. Just like accounts receivable and the allowance for bad debts, right? The allowance for bad debt, the liability balance is a contra asset account because it goes against accounts receivable gross to get the net AR. That's the same thing here in DTA. The valuation allowance is a contra asset account for the DTA. So management must assess whether it's more likely than not that a DTA will not be realized in the future based on all available evidence, both positive and negative. So this is the exercise that management will go through. This is the exercise that will be tested by the audit firm. Okay, these questions will come. We'll be ready for them. Get your story straight. What are you going to tell them when they come to ask you about this? So ASC 740 identifies 4 sources of potential future taxable income, 2 of which are objective and 2 of which are subjective and determined by management judgment. So we're going to go through each one of these in detail. But the first one is future reversals of existing taxable temporary differences. So the first T, taxable temporary differences. Future taxable income, right? If things are going to reverse in the future and give rise to increased taxable income, it's a perfect source of taxable income, right? And that's objective because if I set up the taxable temporary difference, I know over time that's going to create taxable income in the future. That's the DTL. So DTL's reversal is going to give rise to taxable income. I can point to that as sources of taxable income that are going to be sufficient to utilize my DTA. This is number 2 is what I was mentioning earlier. The more objective measure, if I have a carry back potential, is there taxable income in the prior carry back year? Again, I think that's just flipping the pages of the tax return to see if that's available to me in those prior years. So those are objective sources. Okay, I'm not getting into squishy projections or models or Excel files and making that analysis. They're either there or they're not. Right? Objective. So now I also get to look at projected future taxable income. That's the most traditional way you get taxable income. What do you expect to make in the future? That's a subjective measure. Depending on how much you need, it's going to be how much is difficult is that discussion, right? And so that's going to be an exercise of how long do you get to utilize that deferred tax asset? How long is it utilizable before it expires? And what are your projections of taxable income? Okay. We'll talk about that in a moment, about the noise around that. And I can also use tax planning strategies. So there are things I can do, not things I normally do, as a tax planner, but I can do things to create tax. It's actually easier to create tax than it is to not pay tax, right? We know that you need a realizable transaction to create tax. Well, I can choose to do a realizable transaction. I can sell an asset. I have a gain in that asset that makes it taxable, right? So I can do that. I can do that to create future taxable income. Now, there's a lot of tests around that for whether I count that subjective evidence as sources of future taxable income. But this is going to be positive evidence of future taxable income. But I have to evaluate all evidence in making this determination. So we're going to go through each one of these. So future reversals of existing taxable temporary differences. So things that are going to unwind in the future are my temporary differences when I schedule them out, and they're going to give rise to future taxable income. So they provide objective evidence when they reverse in future. Objective evidence in future. For example, the recovery of the excess of book basis over tax basis for depreciable property, whether through sale or depreciation, will cause taxable income to be higher than book income. What that's saying is, remember in the early stages of a new property, plant investment, property, plant and equipment investment, I'm going to take accelerated depreciation. So I'm going to take the tax deduction quicker than the book deduction for depreciation. That's going to cause book depreciation to be higher than tax. Remember on Monday, we talked about I deemed sell that asset at its book basis, which is higher than tax. That would give rise to a gain. My tax affect that's my DTL. Right? Sorry, that's my DTL. That's my future tax liability because future years, that's gonna unwind as book depreciation keeps going, but taxes gradually trailed off, because I front-loaded the deductions for tax. That gives rise to future taxable income. A perfect source of future taxable income for testing whether a DTA is utilizable or not. Okay. If that reversing TTD, when I schedule it out, provides sufficient taxable income, I don't need to record a VA against my deferred tax asset. So depending on how much taxable income that creates relative to the DTA I'm thinking about that needs a certain amount of taxable income to be utilizable, I'm done with the VA analysis. Right? I show that to my accounting firm, but I'm done with that analysis. Okay? So that's the first objective measure. The second one is taxable income in the prior carryback year. Right? That's a simple measure. Do I have, if the issue is I can carry back, do I have sufficient taxable income in those carryback years? Think about that in terms of the capital loss carryback. Do I have capital gains in those prior 3 years? If I do, I don't record a VA, obviously, right? Because what I'm practically going to do is amend that prior tax return, claim that capital loss deduction against that previously taxed capital gain, lower my tax in that year, submit that amended return, and the government's going to send me a refund. Right? That's very straightforward because that's factual in nature. That's not relying on the So then, if I have to go to the third piece of evidence for future taxable income, which is projections, then I am allowed to consider that. It's inherently a subjective exercise, right? You always heard about people whose forecasts or projections are rosy or rose-colored glasses because they're too optimistic, right? Salespeople invariably invest for their sales projections. It's going to be great, right? They never, they're typically very optimistic people, and so they have very optimistic projections. You can imagine what happens in the accounting where all these pressure test that. Is that adequate or is it overly optimistic? So, positive evidence of future taxable income is your prior earnings history. If you've always made money, that's indicative that you are likely to continue to make money, right? That is a great fact in your favor if you have that at your corporation. If we got great products, we continue to create new products, and the market enjoys them, and we sell, right? So strong earnings history is really good. Existing contracts. If you have a backload of contracts, NVIDIA, right? They have this like long-standing, sold out for the next 18 months. They have enormous taxable income. But if you're Boeing and you have a backlog of airplane orders, that type of thing, that will be very persuasive that you're going to be profitable in the future because you already have commitments to the future business. So existing contracts and backlogs are going to be helpful, along with what have you done lately, right? What have you made money similar. The fourth category is tax planning strategies. So you are allowed to use tax planning strategies that are within its ability and willingness, which are inherently subjective, to implement as a source of taxable income. So those strategies must be prudent and feasible, and actions a company would take to prevent an NOL or tax credit carry forward from expiring unutilized. Big DTAs are driven by tax credit carry forwards. In my international tax course, Advanced International, foreign tax credit is a big attribute. Foreign tax credits carry forward for 10 years that are not utilizable in the current year. So those in the future, do we have tax planning strategies that will help me free up and utilize that credit? Okay, it must be, that strategy must be prudent and feasible, meaning that it has to be sound from a tax perspective. You can't just do crazy things and expect it to work, right? It has to be prudent and feasible, and the company doesn't have to do it, but they have to be able to assert that they would do it before that credit expires. They would actually pull the trigger on the planning. Those are the standards you're held to. So You need not actually implement, like I just mentioned, but you must be willing and able to execute the strategy should the need arise. So what are some of those tax planning strategies that would create future taxable income? You can sell assets and lease them back, right? Sale leaseback transactions, that would create a taxable event because you sold your assets. If you sell them for more than your basis, that's gain, right? But still need the assets in your business, so you agree the person who's buying it is going to lease them back to you. But you've essentially moved those assets off your balance sheet, but you've done that in a manner that creates taxable income. That's not an easy transaction. It's easy for me to say, hey, sell your assets and lease them back. Right? That's a big deal for a corporation, and they may not want to do that. That goes to the prudent and feasible and willingness to do it. Right? You can't be this pie in the sky, oh yeah, we'll do this or that. No, would you actually sell your machinery and then lease it back? Okay. Selling non-core assets. So what if you have assets in your balance sheet that you're thinking about exiting, you might not want to do that division, or it's a piece of land or undeveloped land that you don't really need in your business anymore, and you're thinking maybe at some point you might sell it. Well, if the sale of that would create the right taxable income, and you're willing to do that, then that can create taxable income. So you can say, hey, I got this pool of assets that I don't need in my core business, I'm willing to sell them, and I would do that in order to support my deferred tax asset. Changing inventory accounting methods. You can change your inventory accounting methods from LIFO to FIFO, and that will change your taxable income. Again, there are accounting implications to doing that because there's consistency rules. So again, for the faint of heart, you got to think about these things before you make these statements. Are you willing and able to do this, and is it prudent to do so? Refraining from making discretionary contributions to pension plans. Pension plans, the contributions that, so for defined pension plans, if you guys remember back to taxation of individuals, defined benefit plans are funded by the company. It's not your 401k that you put in part of your compensation into. These are funds a company sets aside for these plans. Their deduction is premised on them funding the plan, like i.e. putting cash into the plan. So if you decide to put a bunch of money in there, that's going to lower your taxable income because that's a big deduction. You don't have to put money in there. You can decide, well, I'm going to postpone funding my pension to prop up my taxable income so I can clear out the DTA. Again, it has to be prudent and feasible. What does my pension look like? Is it underfunded already? I have the union complaining about it. All these factors that might bear upon that analysis. This analysis can't be done inside the four walls of the tax department. You have to have the C-suite on board with this. Migrating away from tax-exempt investments to taxable investments. Selling a municipal bond, buying a taxable investment instead. Taxable income. Switching to straight line depreciation from accelerated methods. All those accelerated methods we talked in the first part of the class, those are elective. I can choose not to do that. Now, nobody does that because they always want to front load deductions because it's beneficial. I want to pay less tax now. But if you said, hey, I'm looking for taxable income in the next 2 years because I got DTAs I'm worried about, I could elect not to apply those accelerated depreciation methods and go back to straight line, prop up that. So any collection of all four of those can give rise to sufficient taxable income to utilize a deferred tax asset. So I got to build my file, build my story about this, and make sure people outside the tax department agree that these are strategies we would do.
So does it mean the two subjective sources are more, like the management will have to be more cautious or the IRS will have to be more cautious about it than the objective sources? Because a lot of things.
Not just the IRS, but
Yeah.
this is typically your financial statement. So your financial statement auditor will be the first line of discussion you have, and then you might have the regulator, the SEC, might ask questions about it as well. And where this question really comes up is, so think about what happens. You set up a deferred tax asset. So what you're effectively saying is, I'm going to pay less tax in the future. That's premised upon you having taxable income in the future. What happens when you get to that future date and you don't have the taxable income? That DTA, if you have not recorded a valuation allowance, is sitting on the balance sheet. But it's no longer good, meaning it's expiring. What's the journal entry for an expired DTA? It's an asset. You got to credit the asset to get it off the balance sheet. What's the debit? Income statement expense. And that's going to get people really, really nervous because they're going to say, why did you wait 5 years or 10 years for that attribute to expire and then write it off? What changed when you did your valuation allowance when you first recorded the DTA and you told me that you were going to utilize that asset? Because if you didn't record a valuation allowance against the DTA, you're saying to the world, the investing public and the regulators and your audit firm, that I'm going to use that asset. Then you get to when the rubber hits the road and you didn't use the asset. That's going to get people really nervous and excited about that. Get the regulators asking a lot of questions. So that's where it becomes really important that it's not just, it can't be pie in the sky projections. Oh yeah, we're going to make all this money. It's got to be real. You don't want to get to that point because that point will come if you don't have it. Okay, what's negative evidence indicating that a VA is warranted? You're required to consider negative evidence in determining that more likely than not standard. So you're taking all of these factors and you're coming up with an assessment. Is it more likely than not that the DTA will be or will not be realized? So possible negative evidence is cumulative book losses in recent years, generally looking at the last 3 years. This is kind of the, if you have this fact pattern, you are running uphill to not record a valuation allowance. Your audit firm will be very, very hostile to you. All of a sudden, think of the story you're telling me. I had 3 years of losses, and now I'm going to be profitable. I would be skeptical of that, right? A normal person would be skeptical of that. So be careful if your facts are that you have previous losses, the assumption is conservative that you need pretty strong evidence to show me how are we turning the corner? What's making this year and future years different than the prior years? A history of tax attributes expiring unutilized. If you have a history of NOLs, capital losses, and tax credits expiring unutilized, it's going to be difficult to have that conversation. Well, this one's different. We're going to use this one, right? We're going to be talking to people who are going to say, well, you didn't use any of the last 5. I'm really hard to see why you're going to use this one. An expectation of losses in the future, right? You have things, think of a pharma company that has a big drug on patent that's falling off a patent. Revenue's going to go down. Revenue goes down, profits go down. You don't have something to replace that, that's going to be really important negative evidence that you're going to have the taxable income achieve. Unsettled circumstances that, if resolved unfavorably, will result in losses from continuing operations in the future. Loss of a patent on a profitable drug, right? So if the profitable drug drops off a patent and now the market's not what it was, and you don't have a sufficient replacement for that, it's going to be a difficult conversation. Okay? You're going to look at positive evidence and negative evidence in assessing whether the VA. So let's assume that the company determines that it's more likely than not that its DTA will not be fully realized. So the negative evidence outweighs the positive, right? Whatever that is. Then the valuation allowance needs to be recorded, and the journal entry is I credit valuation allowance, right? It's a contra asset account, so it's going to offset my DTA to get to a net DTA. So it has to be a credit. What's my debit? Toggle over to the income statement, deferred tax expense. So think about what that does when I do that. If I go back to step 3, when I recorded the DTA, what was that journal entry? That was an asset, so I debit asset. I credit deferred tax expense, so I'm crediting an expense account. I'm lowering the expense. This unwinds that income statement effect, right? It offsets it on the balance sheet by putting a contra asset against the gross DTA. But my deferred tax expense now has been debited, offsetting the previous credit, either all or in part of what I did in step 3. So it's trying to get to what are you actually going to use? That's the whole thing, the whole process of evaluation allowance. What are you actually going to use or utilize? And it's all to the more likely than not standard. So that's the unwinding or negating of the initial lowering of deferred tax expense. Importantly, the recording of a VA does not impact current tax expense, right? We're in the deferred world. My current tax expense was step 1 that we did before spring break, right? That doesn't change. So my entries here are to the deferred tax expense. Once I set up the DTA, it's positive, to lowering expense by a credit. If I don't get to utilize it all, then I have to debit it again, setting up the valuation allowance, which causes it to negate what I did in step 3. But that has nothing to do with my current tax liability. It's all in the deferred. If the company determines that a DTA will never be realized, okay, so think about if I just did what I just did, now I have a DTA as a debit, and I have a valuation allowance against it, or either all or part of it, to a net DTA. But it's still on the balance sheet. The DTA is still on the balance sheet. What this is saying is, if I will never use the DTA, then I have to just take the DTA off the balance sheet. And I do that by simply crediting deferred tax asset and debiting valuation allowance, and now it's gone. Right? Because I leave it on there until such time as I think it'll never be realized. Because let's say I'm at 40% likelihood that I'm going to utilize the DTA. So I have not reached the 50% threshold. I'm going to record a valuation allowance fully against that DTA. But the attribute hasn't gone. It's not gone from a legal or a tax perspective, right? The next few years might change. So I want to be able to track it because I might be able to use it. I'm still going to work to use it. If I'm a tax advisor, I'm still going to bring you tax strategies, try to utilize that. I'm going to try to convince you to utilize that attribute. But until such time as that is expired, unutilized, then I have to keep it on the balance sheet. But once it's unutilized, it's gone. Right? I can't use it anymore. So I might as well take the valuation allowance off and the tax asset off and move on with life. And this entry only affects the balance sheet. I'm doing the deferred tax asset and the valuation allowance, which is a liability, because the income statement impact already happened when I set up the VA on this slide here. Right? I reduced the deferred tax, or increased, the deferred tax expense with it via the debit here. So when I take it permanently off it, I don't have to do anything to the income statement because that already happened. Okay, what happens if I set up a VA and then something positively happens that was unexpected when I established the VA? Right? That can happen. New product gets released and they're like, holy cow, I got all this taxable income. I was wrong and I didn't know it at the time, but I can still utilize that deferred tax asset. So if the company evaluates new facts and circumstances, that's very important, and determines the realizability of the DTA has increased such that a VA is no longer necessary, it is now more likely than not the DTA will be realized, the VA is reduced or eliminated. Understand what that journal entry is, then I would lower the valuation allowance, which is traditionally a credit balance, by debiting, and then my credit goes to the income statement, lowering my deferred tax expense. Basically getting back what I had in step 3. Dialing down the VA I have against it because I have new facts and circumstances. Okay? This positively impacts the income statement by crediting deferred tax expense, eliminating some of that negative impact when the VA was recorded on that journal entry in slide 53. Financial statement auditors get heightened sensitivity when you start pulling down a VA. You're doing this journal entry, you're dialing back a VA. The things they'll want to understand is what is new, what changed from when you established the VA till now you're adjusting the VA? It better be something new. If it was something you should have known before, then that prior journal entry is called into question. Okay? And dialing this back, it's a benefit because I am crediting the expense account, lowering the expense account. So they are, as a general matter, nervous about, okay, put up the VA because you're being conservative. Now you're being less conservative. I'm concerned about that. Are you sure you're going to be able to utilize this DTA? Right? You better be. If we get to the end of the carry forward period and you can't utilize it, then this was a mistake in journal entry as well. So just be aware that financial auditors are very, very focused on future adjustments to a VA once you've already reported. It's got to be new, unexpected, and it better be real. All right.
Wanted to ask, so it doesn't affect the current tax expense, it's only the income and balance sheet
Yes.
that get affected?
Yes, exactly. So this is all in the accounting world. But tax people have to be at the table having these discussions because it might be tax planning strategies, future taxable income. All of that stuff requires accountants and tax people and management to all be telling the same story. Nobody wants to be at the end of the day where you have a bad asset on the balance sheet that has to be
But how is that 50% determined? Like, do we compare the
It's
positive
not-
and negative?
It's not easy, it's completely subjective. So more likely than not, that's just building your story. So it's like, say you had $100 that you needed of taxable income and all your positive evidence shows you can get to 101. And everything has to break your way. That's gonna put pressure on that more likely than not, because you need like, say 5 things to go your way. If you think about probabilities, if you stack probabilities on top of probabilities, it starts getting wobbly at the end because everything's got to go a certain way. If you have a really solid evidence on the positive side, that's going to make you feel more comfortable. So it is inherently subjective, and you're just going to be pressured on making that determination. So you got to just make sure you have your ducks in a row and everybody's saying the same. Okay, first example. Okay. So very tiny print. So Elise created a work paper that listed PCC's ending balances and its deferred tax assets and liabilities. So this is building upon the prior examples that we did. So remember, we had one large deferred tax liability that was all driven by fixed assets, our accelerated depreciation. So we had a big DTL, right? Lowered tax basis via depreciation, and book basis was higher. We sell at book value, recover tax basis gain, future gain, deferred tax liability. That's this number. And then we had a bunch of deferred tax assets. So what positive evidence should Elise consider in her evaluation of whether PCC should record a valuation allowance against some or all of its DTAs? But it has an excess deferred tax liability. So the 2.7 vastly exceeds the gross DTAs of 455. This goes to the point I was just making. I have a really good positive evidence with lots of room to cover because that's 2.7 and I only need 455,000 of future taxable income. So I have excess deferred tax liabilities over deferred tax assets of 2.3 million. When the book tax depreciation difference reverses in the future, meaning that I'm going to start my book tax differences, I'm going to start having more book depreciation than tax depreciation. So I'm going to have to reduce my expense, increasing my taxable income in the future, because I already took that in prior years. That's going to provide enough taxable income to absorb the reversing deferred tax assets. What negative evidence should Elise consider in evaluation of whether PCC should record a valuation allowance against some or all of the DTAs? The deferred tax asset related to the charitable contribution is a short carryover expiration date. So the charitable loss contribution carryover of $15,477 has a short life. It only carries over for a certain period of time. So that means I need to schedule out and have enough of the taxable income in the future in those years. Beyond those years, it doesn't help me with that deferred tax asset, right? So she may need to schedule out her depreciation deductions. It will reverse to determine if reversals alone provide enough taxable income to absorb the contribution carryover attributes. Okay. More problematic is the net capital loss carryover, which is right above that. We know I can only use capital losses to offset capital gains in the corporate world. So depreciation is an ordinary income item, right? When that creates taxable income, that's just creating ordinary income. That doesn't give me the right character of income to utilize the capital loss carryover, but I have to do further work to support that line item. A bunch of ordinary income still can't use the capital loss carryover, right? So that might have to go into my tax planning strategies, which saying I have capital assets that I would sell and lease back, or non-core assets that give rise to capital assets, capital gain that I would sell, create the capacity to use capital loss carryover. So that's the exercise, going through each one of those line items. What's going to give me a sufficient capacity to utilize that attribute? Okay, 616, second part is Lily.
So now we'll be looking at that $5,880 net capital loss carryover.
Yeah.
So we know that this has a 5-year carry forward period and is only going to offset capital gains, which gives PCC an issue because any additional taxable income they produce is going to only produce ordinary income. So therefore, they're going to need to rely on tax planning strategies to generate net capital gains in the future. An example of this would be selling a parcel of land held for investment to generate a capital gain big enough to absorb the net capital loss. So basically, the company is asserting that they are going to be enacting these plans before the carry forward expires. So in 2023, their management did not need to record a VA. To them, that DTA is likely to be realized based on the evidence available at the time.
Yeah. So where the rubber hits the road, right? If you put forth a strategy, you don't have to implement it yet. But if you don't, there will be a day of reckoning when that attribute expires. And if you haven't implemented it at that point in time, guess what your journal entry is? Credit, deferred tax asset, debit expense. You took the hit. So it's just a matter of when do you want to take the hit? VA at the front end because you're concerned you might not get to it, or no, I'm going to put forth this great planning idea. But if that planning idea is not feasible or implementable, all you're doing is delaying the day of reckoning. It doesn't go away. If you get to the point where it actually expires, then you got to write off the attribute, the asset. Okay.
Yeah, so like on that note, now let's say that the negative evidence does outweigh the positive. So if a VA was required for the DTA, the capital loss carryover, then we would debit deferred tax expense for that $5,880 and credit valuation allowance for that same amount. This is going to reduce the value of our deferred tax asset and increase deferred tax expense for the year.
Yeah, so now I'm just saying I'm sufficiently nervous, I'm more likely than not that I'm not going to get to this attribute. So I'm going to take the book hit now by taking the expense now. Now, this does not mean that I am cut off ever trying to utilize this attribute. I would still have my tax department, hey, come up with something to utilize this thing, because if I can utilize it, then I would reverse this entry. But I'm just saying for book purposes, I'm assuming you're not going to get something that will. Okay, 617 is August.
Assume PCC has pre-tax book losses of 5 million to 2.5 million in 2022 and 2023 respectively. How might this additional fact influence the lease assessment about the need for valuation allowance? PCC will have a cumulative pre-tax book loss of $1,383,000 over the past 36 months at December 31st, 2023 of 2024. EIC 740 state that the cumulative loss in recent years to consider objective negative evidence that may be hard to overcome. At least we'll have to consider other resources of positive evidence that will outweigh the significant negative evidence in this situation.
Let me pause you there. So they put significant in quotes, meaning that you got a tough job. You've been losing money, and now all of a sudden you're telling me we're going to turn left and make money, right? It's like, okay, why? You're going to have something very persuasive of saying, oh, we're trying really hard. And no, you got to tell me why now is different than what I just saw.
Also, the National Office of Public Accounting Firm will make the determination as to whether a valuation allowance is required when the client experiences 36 months cumulative loss.
Yeah, that national office involvement, national offices get involved in these for major accounting firms. And I think that's actually a good thing because these are very, sometimes the numbers can be large and they're very impactful to earnings per share. And you can have a client that gets very excited about this resolution of this issue. And if you left it to the local office and the local people who are managing the account, there might be some undue influence, I believe, that could rear its head because you're dealing with these people on an everyday basis. The national office, the firms have put this onto them because they are apart from the client relationship. And this is to protect, because it's a regulated industry, right? The SEC can go after the auditor that signs off on these financial statements as well. So the national office is serving that role of trying to protect the organization as a whole about the determinations and have consistency around the country, right? We don't want a St. Louis client not putting up a VA and then a Cincinnati client putting up a VA on very similar fact patterns. So they kind of provide that uniformity around around the country and try to step away from the personal relationship that might be there with the client. And take a dispassionate view of this, looking at positive evidence, negative evidence, and making assessments of the more likely than not standard. And they see you have 3 years of losses, you better come with some very persuasive positive evidence. Okay, 618. Sorry, that's neighbor.
And then now we're gonna assume that PCC just lost the bigger competitor, but the company reported cumulative net income in the current years, and then how much is an additional fact that the rest of the allowance? And the answer is that expectations of future national historical results.
Let me pause you there. So this is saying we were profitable recently, but we have a new event now. We just lost a big customer, right? So you can imagine from an accounting perspective, now they're saying, well, the positive recent evidence doesn't overweigh the current things that are going on. So just the conservative nature of accounting in general. If I see losses, I'm going to be skeptical that you're all of a sudden going to be profitable. If I see income, that doesn't mean I don't look at what's really going on in the business. And the current fact causes real problem. So what would we do in this case?
In this case, we would have to seriously consider whether a valuation allowance would be required to the extent that reversing taxable liability expenses will not absorb future losses.
Yeah, so if those reversal of that deferred tax liability for that accelerated depreciation we took for tax purposes, that's enough, I may be okay. But I also have to layer that in with the results of losing business. Okay, so that's step 4. All valuation allowance focused on DTAs only. DTLs go on the balance sheet and I don't assess whether I have the liability or not, right? We put liabilities on the balance sheet quicker than we do assets. Okay, so step 5 is now I have to evaluate a need for what is called an uncertain tax benefit. Okay? And I'm reserving here because hopefully you appreciate that the answer to every tax question is not straightforward. Either I have messy law that's not directly on point, I'm not sure how it applies to my situation, or I have messy facts, and so I don't know how to apply the law to my messy set of facts. So every tax determination is not binary, you're either right or you're wrong. You might be right, you might be wrong. So that's the space I played in as a tax planner, because telling somebody the answer to a rule where it was straightforward is like, even pre-AI, was pretty simple. You just look it up in a book. And I just type it in. It's the gray area where something's not exactly certain. That's when you bring professional experience and perspective to the account. And companies do a lot of things that are not certain. Think about everything else on financial statements. There's a whole bunch of things that aren't certain, right? My sales, my business, my assets, my liabilities, all those things. I'm doing my best, but nothing is certain in the business world. Nothing is certain in tax, okay? Not everything is certain. So the reason for that is taxpayers and the IRS can differ in their opinions on whether an expenditure should be deducted or capitalized, right? Reasonable professionals can differ, right? It happens all the time. So the government can differ from what the taxpayer says this should be the result, right? And whether income should be currently taxable or deferred. Remember our deferred taxability on items, you had to usually meet certain requirements. Did you meet all those requirements? What if the government took issue and you didn't meet that requirement? That's currently taxable. Or should something be exempt from taxation? Taxpayers and the government can go to court over a tax dispute. There's court cases going on every day about tax disputes, just like any other dispute that's out there. So that matter that is subject to that court exercise is not yet determined, right? There's differences of view. Taxpayers' positions can be disputed by state and local tax authorities. So we talk about federal tax, but you're also a taxpayer in the state and local jurisdictions in which you're doing business as well. They can have issues with the same thing. Your views on whether a certain law applies a certain way. And foreign countries. So if you're a multinational corporation, you're doing business in all these countries, you're going to have disputes as well in those foreign countries. So I like to think of it as there are people out there, lawyers and accountants, that deal with this inventory, and their inventory is dispute cases around the world. And you want to talk about something that's never going to go away. That ain't never going to go away. There's always going to be disputes around there. And so you're trying to manage that portfolio of cases, ultimately trying to get to the best resolution as possible, but also trying to do it in a fairly efficient, straightforward, and timely manner, right? But all of that stuff means that you could have a bevy of uncertain tax positions. So do you record 100% of all of those in your favor? Or are you going to set up reserves in your financial statements because you know you're not going to win all of them, right? Nobody bats 1,000 on disputes with governments, right? You're going to lose some. And so you're going to have some that you feel really good about. You're going to have some like, that one's 50-50. I'm not sure I'm going to win that one. It could go either way. And so that is the assessment here in step 5, is looking at all my tax positions for every jurisdiction in which I'm doing business, and do I need to reserve part of the benefit? Okay? And that benefit is either a lower income, gross income item, because I'm saying something's not taxable, or it's a higher expense that I say may be deductible, and the government may say it's not fully deductible. Okay? So for financial accounting purposes, the company must determine whether it can record the current, so this is going to be a current or future item, from an uncertain tax position in its financial statement for the period in which the transaction takes place, knowing that the ultimate resolution of the tax position may not be known for some time. Right? When you file your tax return and you take a position on a tax matter, that the process isn't even going to start for years from now. Right? You file a corporate tax return, You may not get your first question for 2 years after you file it. But the standards in accounting is when you file that tax return, you have to assess, are there any uncertain tax positions in that file at that period? You can't wait until France complains about something in 3 years. That's not the appropriate time. That could happen, but you need to have made that assessment at the time you file that tax return. So this is called FIN 48. Some of you may have heard this in your accounting courses, but FASB interpretation number 48, everyone calls it FIN 48, is accounting for uncertainty in income taxes, and it provides guidance in this area. It has a 2-step process in evaluating tax positions. We're going to go through each one in a moment. So step 1 is recognition. So I view this as a gating item. I don't put anything on the balance sheet unless I meet the recognition standard. Okay? That means if I get through step 1, I get to put something on my balance sheet. Step 2 tells me how much. That's the measurement exercise. But when people are preparing their tax provision, they're always doing a FIN 48 analysis. They're going to have, again, think of it as each company has their inventory of dispute items around the world. Now, some of them may be real disputes. They've already kind of started. Like, you knew France was going to complain about something. Well, they started complaining about it. You got to start dealing with that. Others may not even have been started a discussion yet, but you know that it's coming. You've done your work when you filed that tax return, and you know, I know the government is going to not like this, and we're going to have some discussions, and I might have to go to court on this particular item. So you know that's coming, even though I may have not started. That goes into the measurement. Okay, so step 1, recognition. So you first determine, and the standard here is like the standard that we talked about for VAs. It's a more likely than not standard. So you must first determine whether it is more likely than not that its tax position will be sustained by the IRS examination or whatever equivalent of the IRS is in another jurisdiction based on its technical merits. Okay, so you have to get very granular here. I'm looking at very dispassionately on the technical merits of what position we've just taken. Is it more likely than not that I will win on my view? I must presume that the IRS will examine the tax position. So I can't hide behind the fact that, remember, we self-report taxes, and then the government decides what they want to look at. I can't assume that they won't look at what the issue is. The guidance here says you must assume the tax authorities will ask the question. Okay, so you might hear this sometimes called audit lottery. Like, not everything that you put on a tax return gets a question. So sometimes you get lucky, and the authority just decides not to ask a question about the topic. You have to have that discussion. But in this fictional world, you have to assume they have visibility and will ask the question. And the company can consider how the tax position might be resolved if litigated. So you don't have to have the IRS agree with your position, but you have to be able to say then, if they don't agree, and I go through all the various levels of appeal within that administration, and you still don't agree, I will go to court. Not only will I go to court, if I lose a court case, I will appeal it to the next level of court. Appeal it to the next level of court. I can make that assertion, but I have to be willing to be ready to do that. That's not an easy exercise. It's not timely. It's costly. I got to pay lawyers. I got to pay litigators to do this. It's how much dollars at stake are here, right? If there are more dollars at stake, I might fight harder. If there are smaller dollars at stake, you're gonna deal with that early on in the dispute process. But it's a big ticket item. I might be willing to say I'm going to go through the time and expense of fighting this because I truly believe in my position. The government doesn't have to agree with that, but that doesn't make them the expert on the application of the law. Now I'm in the world of I'm spending some accounting fees and I'm spending some lawyer fees. This is headed towards that area. So first I have to say all that. So I have to assume that they're going to ask the question. And I can consider how far I push the issue through the system, I have to be at a more likely than not that I will win. If I'm at 49% that I will win, I will record 0 in my financial statement. It doesn't mean that I haven't filed my tax return, because I did, right? I did claim that benefit on the tax return. And I would still fight it through the system, because there's real dollars at stake. It's just I haven't recognized any on the financial statement. I set up a reserve against it. Okay. I have to at least be more likely than not, 51%, before I put anything on the financial statement. Okay. Let's see if there's any. Yeah, so if I am at more likely than not, then I can recognize some of the benefit. And what would that be? I would reduce my current tax expense if the item impacts the current tax year. So this one does go to current, or it could go to the future, depending on where the issue is. And or increase my deferred tax benefit if the item is expected to impact future years. So that's what I'm doing here is do I keep all of the benefit in the financial statement, or do I have to reserve it? Okay. So 619 is Mayor.
So now let's assume that PCC has taken over 100,000 on its 2024 tax return, and that there was some discussion about whether all of the taxes is covered by the credit. The question is, what threshold must be met before PCC can recognize any of the tax benefit from the research credit on its financial statements? And the answer is that PCC must determine that it's more likely than not that its tax position on the research credit will be sustained by the IRS.
So I filed a tax return claiming a research credit of $500,000, and now I'm doing my tax revision process to put those entries on the financial statement. And if I have uncertainty as to the sustainability of that, I have to assess whether it's at least at a more likely than not perspective before I even record anything on this. And it's at a very granular level. It's not the whole tax return, it's this item on the tax return. And that's where I'd have my tax department really weighing in on this, my tax advisor really weighing in on this, and build my case that I think I can sustain at least 51% that I will win 500,000. Okay? Okay, so let's assume that if I'm not in that threshold, about 49%, I have to reserve fully that 500,000. But now let's say I'm at least at 51% based on the merits, based on my access to the court system, that I will win on that. So now I have a measurement test, step 2. So now I must compute the amount of the tax benefit to recognize in the financial statement. So now it's not whether I record something, it's how much. The measurement process requires the company to make a cumulative probability assessment of all likely outcomes and then recognize the largest amount that has at least a greater than 50% probability of being sustained on examination or litigation. What all this is saying is, it took me a while because there's a lot of terms in there, cumulative probability assessment. I think what the guidance here is saying, usually an item that is truly in dispute, usually it doesn't go one side fully wins, one side fully loses. At some point in time, they cut a deal. Okay? So as you're going through, the IRS auditor might say, I want to take an examination of that research credit. And then he's like, well, there's nothing to see here because it's clearly I'm entitled to the 500,000. And they may take an issue like, I don't think it's fully the 500,000. It's not 0, but it's not 500,000. So you could agree at any point in time through that process, and as you appeal, if you lose at the IRS level, you can appeal through the administration, or you can go to court and heard about people's settlements in court cases, right? Okay, let's go cut the difference and meet in the middle and call it a day and move on with life, right? Or if you feel like your facts are a little better, maybe you want 75% of the benefit. And the government's willing to say, okay, I'll haircut it by 25. We'll agree to that. So that's what the measurement process is doing. Where are you ultimately going to land? Because if you're dealing with an uncertain position, the chances of you getting 100% might not be there, right? might be something short of that. So that's what this is doing. And so this exercise, I think is really brought out in the examples here, and you can kind of see how, but you have to have this scheduled out. So 620 is Hollis.
PCC determined that it was more likely than not that the tax position in example 619 would be sustained on audit and litigation.
That's our step one, right? So we got in the door, we think we're more than 50%, and we're gonna win on this issue.
And then the tax department calculated the probability of receiving a full or partial benefit after resolution of the issue as follows. And then it goes through the table of the potential estimated tax benefit, the incremental individual probability of being realized, and the cumulative probability of being realized.
Yeah, so I added the incremental here because if you put forth, this is a credit, right? This is a research credit. So as I start claiming less and less of the credit, you're going to have the government complain less and less, right? So if I'm willing to go down from my opening bid of 500,000, my probability of winning goes up. So you can see I get 60%, and then an incremental 25, an incremental 10, and then I get, this sums to 100. If I claim 0, I have a 100% chance of getting 0. The government's never going to complain if you don't want to claim a credit. Right? I give you absolute certainty on that statement. You will get 100% certainty the government won't complain if you don't claim a credit. So it's all about getting to this, and the way they have the schedule is the 60 and the 25 equals to 85, and then incremental 10 gets you to 90. Okay? So walk us through the final conclusion.
And the rule is to recognize the largest amount that has at least 50% probability of being sustained on examination or litigation. And that number is, the largest amount is 500,000 with a 60% cumulative probability of being realized. So they can recognize all $500,000 as a research tax credit on the ultimate settlement of the tax.
Yeah, so if you look at the far right-hand column, and those numbers have to be greater than 50, and whichever one of those numbers has the greatest amount, then that's what gets reported. So the 500,000 is good here because I have a 60% probability of winning 500,000. I get a pretty good position here. It's not certain. I have a 40% chance I could lose. Right? This is an area where there's no certainty in this particular issue here, so I could lose on this topic. So it's just I don't have to reserve it. Yes, Jeremiah.
How are those individual probabilities determined?
Very hard. Very hard. This is professional experience. You would need somebody who has very deep knowledge of research credit, positions of the government, how your facts are different or better or worse than the positions the government takes. And so you spend a lot of money on this. You end up getting tax opinions if it's an accounting firm that's doing it or a law firm that's helping you do this. But that's the only way you can do this because it's all subjective. And you just got to do your best in this. But that's the standard penalty. And it's not dissimilar than a lot of things in accounting, right? Best estimates. It is a difficult exercise.
If your predictions are wrong and you end up losing.
Yeah, great question. Great question. So again, it's not certain because right here, even your work says it's a 40% chance of being wrong, which is pretty significant, right? I have a 4 in 10 chance of losing on this. So if I do lose on this, and then I have to reduce the benefit, right? Because let's say worst case scenario, I go all the way through the court system and I go to the Supreme Court of the United States. The Supreme Court of the United States says, I vote in favor of the government. You lose. Then I need to take down a $500,000 benefit that I have in my prior financial statements. Now, that's not the end of the world, okay? But it highlights what Jeremiah was saying. Was this exercise done correctly? Should the probabilities have been different, right? And that's not to say that you're automatically wrong because hindsight's always 20/20, right? So it's easy for someone to throw pot shots at estimates when it doesn't come to bear, but it highlights the degree of effort you need to put behind this. And then you have to say, well, I had no idea, or this was a crazy decision, I don't agree with it, but it's a crazy decision and we lost. There's no other place to go once you get to the Supreme Court. So it's an unfortunate prospect, but this is uncertain. So you just have to remind your CFO or remind everybody. I never said it was 100% certain. Good question. Okay. The amount of the current tax benefit that is not recognized is recorded as a liability on the balance sheet. Usually income tax is payable with a corresponding debit to current income tax expense, right? Because this is, say you drop that $500,000 on the tax return, if you didn't get to record all of the $500,000, what you gotta do is lower your, or increase, your current tax expense by debiting it, and then you have to increase your current tax payable because you're gonna pay more as an estimate because you're providing that you might have to pay more in the future. Okay? So that's the journal entry that you would do if you weren't, if you were doing tax benefit. 621 is debit.
So for 621, assume that PCC tax department has assessed the cumulative liability of sustaining the 500K research project as follows. So based on the least probabilities, how much does the uncertain tax benefit of 500K PCC recommend? So according to the previous slide, 63, we need to, the largest amount that we can realize is the at least is the largest amount at least greater than 50% probability of being sustained. So in this case, the accumulated probability that's greater than 50% is 70%, and that correlates to the potential estimated tax benefit of 300K.
Let me pause you there. So this is different than the prior example we just went through. So I filed the tax return claiming $500,000, but let's say there was uncertainty in the law or uncertain in my facts. If you ever deal with research credit, it's very factually intensive about what is the research that's being done and does it qualify or not. And so say there was a segment of that research that I think I'm entitled to a credit for, but the government might not agree. That might lead you to say, well, I put $500,000 on my tax return, but I actually feel better about $300,000 because there's that element of research that gave rise to the extra 200 that I don't feel as good about. So that's what might cause your cumulative probability to be higher at 300,000 than at the 500,000 you file. Right?
And then according to the previous slide, when we were there's the difference between 500K and 300K is 300K. And then for uncertain tax benefit reserve journal entries, so we would debit a current income tax expense of 200K and an income tax payable of 200K.
So I still filed my tax return claiming the 500 because I feel good about that. Right? Not as good as 300,000, but I have a on-file tax return on that, and I'm just I'm reserving the exposure on the extra 200,000, but I would still fight for my position on the tax return. So when the IRS comes in and they hone in exactly on that issue that I had, oh, that research doesn't count for the credit, I would argue my position. You know, I think I am, but all this is doing by this journal entry saying I'm just reserving that for accounting purposes. Right? I don't feel as good about it. That's what the measurement said. Okay. Okay. Subsequent events. So FIN 48 requires a company to monitor subsequent events. Those that the issuance of new regulations and the issuance of court opinions that might change the company's assertion that a tax position will be sustained on audit or litigation. If the facts and circumstances change, a company must reevaluate the tax benefit amount it expects to realize in the future. So your issue is not, many times, not just self-contained to you. Other taxpayers may have similar issues, and the degree of correlation to your issue or your facts may or may not be higher on certain cases than others, but the government is sending out regulations all the time, which is their view on the tax law. So the Treasury Department issues regulations interpreting the tax law. If that comes out and it's directly against your position, you might need to reassess what you're doing, right? You might not say that you're wrong, because regulations sometimes courts find in favor of taxpayers even against regulation, but you know the government doesn't like what you just did. They just gave you a bunch of rules that, in that prior example, affect that $200,000 incremental research credit. Or there might be a court case that gets decided, and other taxpayer just lost on the issue that you have. And you're like, oh, geez, that's awful, because now if I go to that same court, I bet they're going to decide it the same way, right? So you have to be monitoring subsequent events. So you do your best when you file your tax return, but things are going to change all the time as you're going through until you get to the end. So this is an interesting one here. This is a big issue that's always in the court system, but this is about transfer pricing methodology for cost sharing, and cost sharing is a issue that comes up in intellectual property. So many multinationals have intellectual property all over the world. Some of them have moved it from the United States to outside the United States. All companies you know have done this. Apple has done it. Many companies, brand name companies have done something like this. And the government's in various stages of potentially challenging some of those transactions. So what this is saying here is the IRS filed an appeal. So they lost in the U.S. Court of Appeals because they're going through the court system. And they went, the Ninth Circuit held in favor of the IRS on a 2-to-1 decision. And at the time, Microsoft had a similar tax-related uncertain tax position and made the assessment that they were not going to make any adjustment to their uncertain tax reserve position based on that court case. Okay. Another company, Juniper Network, had a similar issue and took that court case and made their own determination, and they did reduce its uncertain tax benefit by that. It's all going to be based on your company's facts and your interpretation of that decision and how it would apply to your facts. But what this is saying is these companies have to monitor all of this around there, and this is usually legal opinions that are coming in. Either our facts are sufficiently different, make us in a better position than who was in court, or a worse position than who was in court. And then this has to be monitored to see if you have a subsequent event that you need to account for as well. So these are all in footnotes to these companies. That, you know, when a big court case like that comes out, they have to reevaluate and then make a determination. So the disclosure of uncertain tax positions. So imagine, right, we self-report our tax return, and then the government decides what they want to look at. If you were working for the government in an audit capacity, you'd probably like to know these uncertain tax positions, wouldn't you? Because the accounting literature has made companies highlight the issues that they are uncertain of. I would want to know, if I was a government auditor, tell me all your uncertain tax positions. I'd like to look at those. I don't want to have to search for a needle in a haystack and look through your tax return. Just tell me what those are. So the companies must disclose aggregated information rolling from beginning year balances to end of year balances for all uncertain tax positions. So the government, having power of the pen, says you must tell me what your uncertain tax positions are. I am leveraging off the accounting literature for you to highlight to me problem areas in your tax return. This caused an uproar when the government decided to do this, because taxpayers are like, well, we're doing your job for you. We're sitting here and serving it up to you. When you come in, you know exactly what my issues are. And the government said, yes, that's what we want. You shouldn't be filing tax returns that you're afraid to have a discussion about the uncertain positions. Okay, so you must report increases and decreases. These are all called UTPs, uncertain tax positions. Everybody calls them UTPs. But tell me what your UTPs went up or down. Increases in UTPs for the current year, so stuff you just filed. What's that inventory of items? Increases or decreases in UTPs due to settlements. So if you settled a case, then I want to know what you had reserves for it. If you reserved 100 and you settled it for 25, did the government leave money on the table? Because you were concerned up to a $100 level, and I only got 25 out of that. Are increases or decreases to UTPs due to lapsing of statute of limitations? Statute of limitations, if you remember from individuals, is the amount of time from the filing of a tax return to when the government has to make a question about it, after which the year is closed. No questions can be asked. So if you have an uncertain tax position and the question never gets asked and the statute closes, you win. Because you got the full benefit, right? Because nobody can ask a question about it anymore. So if you had an uncertain tax benefit, you get to unwind that. So that's number 4. And decrease to a UTP means that your statute limitation is you won, nobody asked the question, you can't ask anymore, so you don't need a reserve money. So the opponents of such disclosure worry this makes the IRS's job too easy. Because we're serving up, here's the inventory of stuff for you to talk about for the next 3 months. Yes, General.
So like for number 3, it says that due to the settlement. So if the government sees a settlement and there's like, you reserved way more than what they settled, can they argue it?
No, because when you settle a case, then the lawyers will paper that up to where you agree that you will pay or not pay whatever the settlement says, and the government will agree to the issue's dead. I'm not going to talk about it anymore. But what it does do is it gives the government evidence that they can maybe use in the future, and other taxpayers, like, we left money on the table there. We should be more aggressive with other taxpayers, assuming they're all making a similar assessment. So yeah, it doesn't mean that they can go back to that particular taxpayer, but it might give them some evidence that you're being too soft on taxpayers. So here is Microsoft's UTP disclosure. Look at the size of these numbers. This is 17. That's millions. That's 17 billion. These are huge numbers, and now it's a global company, massive in size, but this is the roster of all their UTPs. Beginning of the year, that number. Here's the changes as they monitored increases, decreases, statute of limitations and everything, down to the bottom number, and you can see how that number has increased. So if you were auditing Microsoft, would you want to know what all these items are? I sure would. What's this one here that's 4.2 billion? I'd like to talk about that issue, right? Now, they're a very well-advised taxpayer, so they have lots of smart people helping them. So they have positions that are very well developed, and that they're going to fight hard for. They have deep pockets. But like that prior case, the government's still chasing them on that cost sharing arrangement. So notice the lack of jurisdictional detail in each of these lines. For a multinational company, nothing here says what's U.S. and what's not U.S. What's federal, what's state and local. So there have been some proposals to get some more granularity on this so you can see exactly what it is. But this financial statement, this is a financial statement footnote. It doesn't tell you exactly where the issue is. It tells you, not like you got some big issues, but I don't know. Are those all in China? Or are those all in the U.S.? Are they state issues? I don't know what those are. So there's detail behind this, obviously. It's just how much is. Okay, so we will finish this off and then start in on the next chapter, which is going to be more transactional and data about quality. Okay? All right, I'll send you notes on both of you.
For the prep call
I didn't finish, but I can do it right now. We can text. Thanks.
We're such a
Thank you.
What are you doing?